All right, welcome back to another episode of the Black Bullion Show. Gold and silver have both bounced back today on the back of a declining DXY. However, I wanted to talk to you all about a pretty interesting trend that I've been trying to piece together for some time now. And I have to thank Lyn Alden's articles for helping me to glue some of these seemingly disparate pieces together. But here's the crux of our discussion today, guys. Monetary inflation is truly a sleeping giant right now. And of course, much of our discussion will center around the bond market. So if you're ready to start this deep dive, let's begin. But first, if you're new to this channel, please hit that big red subscribe button right down below. Also, please hit the like button. Helps to get this economic evangelism right on out there to the masses to bring more people into precious metals. So before we begin, let's outline our discussion as beginning, middle, and end. The beginning kicked off what Lyn Alden calls informal yield curve control. The middle of our discussion in this video is what we're living in right now, which is less Fed bond buying because they've been keeping a watchful eye on and are likely conducting a test to see if inflation will remain subdued if private investors buy bonds. Now, the end of this video and the end of our discussion will be marked by inflation or potentially subdued inflation if the Fed is successful in their actions. So let's start at the beginning. So take a look at this chart right here. At the beginning of what we call on this channel the ronies, the foreign sector and risk parity funds dumped US treasuries. Because no one wanted to buy them, yields spiked, as you can see in the red right here. Obviously, the Fed doesn't like that. So they had to step in and buy all of that slack with newly printed bucks, as you can see. Now, this is what Lyn likes to call informal yield curve control. They didn't formally say, hey, we're going to be doing this. It just happened. Now, here's how much in treasury assets the Fed bought since the beginning of the ronies. Again, doing their informal yield curve control. Just take a look at how things spiked here. Now, let's pause before we get ahead of ourselves. So what's the point of the Fed doing this? It's because they fear inflation. Now, more on that fear of inflation will come at the end of this video, at the end of this outline. So let's skip ahead to the middle of our outline. I have my notes here, so I wanted to keep this very succinct and very easy to understand. So let's get on to the next section. So since the beginning of the ronies, the Fed, has slowly stepped back its purchases of bonds so that the private sector and others can buy them. And in this graph here, you can see that the Fed really started to step back from its purchases in June. June's right over here. And these gray bars show the Treasury's net supply. So it just increased, and their purchases start to mute a little bit as compared to the beginning when they actually were buying more than what was available. Now, remember, this part of the story is all about the Fed backing off so they can test and see if other buyers will pick up the slack during auctions, treasury auctions. If they do, then they can solve for inflation expectations by having to buy less of these treasuries themselves. So, did the private sector step up to the plate? Well, let's find out here. Now, this again, it comes from Lyn Alden's piece. So I'm just going to read this quick section here to see if they stepped up to the plate. Now this section is called the recent spike. Within the past week, however, Treasury yields moved up swiftly. Now this is her referring to August. This happened back in June and then corrected back down. Now it's happening again. As you can see here, you got the spike. It may not seem like a lot for a 10-year yield to move from 0.52% to 0.71% between August 4th and August 13th, but that's a 36% yield increase in 9 days, or a 36% higher funding costs for the federal government on much of the Treasury curve. With rates as low as they are, these June and August spikes were a big move in relative terms, although not nearly as significant as the mid-March spike. In addition, when those rates spiked in June and August, we saw brief growth to value rotations in the broad equity market, as the market quickly priced down growth stocks a bit and priced up some beaten down value stocks. Now guys, right now in September, we have the auction going on. Think about what's been happening recently. A lot of these growth stocks have actually been beaten down in recent days. Just keep that in the back of your mind. Let's continue. If we move further out on the duration spectrum, this recent 30-year Treasury auction wasn't very smooth. Bloomberg reporters quickly covered it. Here's one tweet from Catherine Greifeld saying, "Yeesh, that's an ugly auction. U.S. 30-year bonds draw 1.406% versus 1.382% pre-sale when issued yield." Here's what Lisa Abramowicz tweeted. There's a bit of unease developing around this week's record sales of longer dated U.S. bonds. Today's $26 billion auction of 30-year notes didn't go that well, leading prices to fall and yields to rise across the board. Interestingly, stocks have dipped lower in tandem with bonds. Now, with this, it looks like the June and August auctions weren't successful in courting private investors into bonds. So guys, currently, we're in the midst of another Treasury auction right now. Today is actually the 10 years auction date. If these auctions continue to be unsuccessful in courting, for example, risk parity hedge funds, the Fed will have to take us into the ending part of our story, the ending part of our outline. So, what have hedge funds been doing if not getting into bonds at the rate that they used to? Well, they've been doing this. They've been getting into gold. Again, if you expect inflation, what better way to allocate your fiat than getting into gold? Now, since June, we've seen the rate of gold prices increase as more institutional and retail investors, got into gold. Take a look at this rate of increase here from right before that auction in June, and just went right up. And just look at how pretty steady the gold price was for some time, going back into early April. And then by June, things really took off. Now, got some more notes here. So guys, what about now? Well, we're currently in a period of consolidation, as you can see here, post such a massive run-up that we just had. But that doesn't necessarily mean hedge funds have been scared away. They're just waiting in the wings. This article is from August 24th here and states the following. Just have this brief highlight here that I'm going to read. Looking ahead, some analysts are expecting that funds continue to reduce their exposure to the precious metal as prices were unable to hold the critical psychological level. Some analysts have said that the trade data is the latest evidence that gold has entered an important consolidation period after an unprecedented run since the start of the year. So if inflation continues to rise, I can only foresee gold continuing to get a bid. So since today is actually the auction day, let's see how the 10-year yield has been performing. Let's see here. All right, so today on auction day, the 10-year note yield has been climbing up. We just saw that it crossed the 0.7% line, and now it's back at the very high 0.6s, 0.698, but it was definitely above that. Let's take a look at how high it got. It got to 0.707. So it's been rising, and we'll see how things progress throughout the day, but honestly, that's not a good sign of private sector buy-in for the 10-year. So now, what threats loom on the horizon in the ending of our story, in the ending of the outline that I sectioned out here at the beginning of the video? Well, it's this right here. Consequently, the U.S. is vulnerable to foreign liquidation of securities comprised of U.S. Treasuries and other bonds, together with portfolio investments amounting to 20% of total U.S. long-term securities extent. So far, on a net basis, foreigners appear to have stopped or slowed their net buying of U.S. securities and cash dollars. Some positions will have been unwound by U.S. hedge funds and other entities operating in the FX swap market rather than foreigners, driving the dollar's trade weighted lower by about 10% so far from its March 23rd high. But foreigners appear to have not yet begun to sell dollars in meaningful quantities. When they do, they will be selling U.S. Treasury and corporate bonds and liquidating equity portfolios as well. And if they do so at a time when there are insufficient domestic buyers to absorb their selling, these markets will crash along the dollar, which will be sold as well. This is what keeps the Fed up at night, guys. We had a foreshadowing of this selling pressure back in March, which caused the Fed to undergo its, again, informal yield curve control. Now, that on top of auctions not producing desired results, that may cause the Fed to implement their informal or formal yield curve controls. I doubt that they would let inflation pressures run too hot. But hey, we'll see how things turn out. So everyone, that was your Wednesday. Hope you have a good one. Please hit that like button. Please subscribe if you're new. Hope you enjoyed this. I really enjoyed doing all that deep dive for you guys. It's Black Bullion.